Although consumer confidence rose slightly for March, shoppers remain wary of an impending recession that we've talked about a lot. At Shoptalk in Las Vegas, Brian Sozzi caught up with Simeon Siegel, BMO Capital Markets senior analyst, for a check on how retailers are feeling right now.
I think the beauty of these conferences are they are in person, and this isn't the first one we've had since COVID, but still feels like you can see the excitement. That's interesting when you think about who we're dealing with. We're dealing with retailers. So these are people that need this. And so I think the nature of these conferences, there's a lot of buzzwords, whether it's AI, whether it's supply chain, whether it's more AI, right? It keeps on going where you're trying to figure out what's the next greatest thing. I think what you and I want to know is, what are the companies doing, right? At the end of the day, the next greatest thing will only matter if you can get the product and you can forecast supply demand. So it's interesting seeing the dichotomy of where people are going. The mood overall seems pretty positive. I just can't tell if it's because we're in Vegas.
You cover, 26 companies?
Who's counting?
I'm counting, because as you talk to these executives at these companies, what's their mood? We are living through some form of banking crisis, whatever it might be. Are they seeing a pullback in sales and weaker profit margins?
So I did a panel here yesterday. The first question was, 2023 is the year of, and to make it fun, there was a list of words, taboo style, that you couldn't say. My word was divergence. I think right now, by the way, and I thought it was really clever, and everyone's like, it's kind of a boring word, but right now, you've had years where you couldn't get product you wanted, right? You and I talk about this all the time. It is hard to be a retailer. You have to predict demand. For the last few years, you had to predict supply, and that was impossible. We're back to being able to get the product that you want, which means now it's your job to make sure you're buying the right stuff. And so when I talk to different C-suite, when I talk to different companies, I think the mood is, the future is now back in my hands. Now, this is pre-recent financial conversations, so I think people are still trying to absorb what changes for them, if anything. But the mindset of, I am running a retail business or a brand, it's my job to know my customer, I'm finally able to do that. Those that are comfortable feel like they're going to make it through. It's not going to be easy, they're going to make it through. Those that are not are discounting.
Because what we are seeing in the economy right now, do you expect a more promotional spring selling season?
I do. I think that, for better or worse, the flip side of the supply chain conversation is there's a lot of savings coming through. A lot of companies expect a lot of margin savings because it costs them a lot less to ship a couch over a container over the ocean. I think the problem with that is when you're given savings, you tend to spend them. The easiest way to spend them is with promotions. And so what I fear that everyone thinks this is going to be a great margin year because of supply chain benefits. I think what they're going to end up doing is go back to the cookie jar and use that to discount. I think if you're a consumer, expect deals. I think that's where the divergence comes in. For better or worse, John Idle, CEO of Capri, has made very clear he's not going to promote. Tapestry has made clear they like the brand equity that they have attained. Others, not as much.
Out of that list of 26 companies you cover, one is Gap. Now, in this promotional environment, what happens to a company like Gap that has been struggling for 25 years?
Yeah, so Gap is an interesting one to bring up because it's a great segue. Because Gap just reported earnings, told us that they had over 500 basis points, 5 percentage points worth of margin benefit from supply chain, improving their gross margin. Do you know what their total gross margin was? Down. All of that savings was netted out via discounts. They need to bring the Gap brand back to its power. Otherwise, it's going to be this ongoing promotional decline. I think listen, what Gap brand, you and I had this conversation about Victoria's Secret a long time ago. Brands aren't dead if they sell multi-billion dollars of revenue. That means the consumer has given you the proof of concept to say, I value this, right? A brand is as big as its revenues. It's as healthy as its margins, but it's as big as its revenues. Gap's a big brand, not very healthy. So sell less, charge more, make more money, right? That was my mantra of COVID. Most of them, we've passed through that. Gap never did it. And the issue with sell less, charge more is it needs to be intentional. If you let the revenues collapse on their own, chances are you're going to lose margin and top line. If you say, I can be a healthier but smaller brand, and I need to just focus on what made me special to whoever it is that views me as being special, we're selling apparel. This is a business that should be profitable.
Can a new CEO save Gap? Because they are supposed to get a new CEO.
Correct.
At some point.
Correct.
But the search has been, over 6 months?
Yeah, you told me you threw your hat.
No, you before me.
You're asking for the rest of the year?
I'm not going into sinking ships.
By the way, there's a lot of treasure in sinking ship. That's where the best treasures lie. I think that absolutely, right? But it's interesting because you asked, can a new CEO of the Gap improve as opposed to a new CEO of GPS Inc.? I think that's exactly what they need. They're hiring for a CEO of GPS, the company. Gap, Old Navy, Athletic, it's a big conglomerate of various different companies in various different stages of their life. What they need to do is find someone who wants to improve the Gap, right? Because Old Navy's a beautiful business. Probably doesn't grow a whole lot, but it's a very big business that should have a healthy margin. The Gap is the business that needs to be focused on, needs to be turned around, and it needs to be turned around, in my opinion, not via incremental sweaters, but incremental profits.
All right, let's stay on another disastrous business that you follow. That's Peloton. You've been very right about Peloton, Simeon, really for probably over 2 years. Underperform rating still. I now see TV ads for them. The price for that bike, under $1,000. I recently got offered 3 months free because they messed up my billing. None of this sounds healthy to me.
Yeah, I think the interesting dynamic, Peloton was viewed initially as an internet company. I think you and I understand it's a brand. When brands, A, have too much inventory, or B, have too much ubiquity, they lose the ability to price. And the first sign of an eroding brand is discounting. The problem is it doesn't stop, and that's what we're seeing. And when you don't have that, the scary part, by the way, is that those price levers don't seem to be driving unit.
Well, should this be a $500 bike?
I think the bigger question, by the way, if you think about the way they're approaching this with fitness as service, is should it be a free bike that comes with an attached subscription? I think that's the way the company is viewing it. I think the answer is every single person that already has a bike, that's already paying the $44 a month, those are great customers. That's a great subscription business. Focus on them. Every incremental person that you need to drive the bike, every time you and I talk about it, I mean, we're talking about it right now, that the brand feels the need to discount. The refurbished bikes below $1,000 means they're getting old bikes. That means someone's giving them up. And they can't sell them as well as they wanted to, so they have to discount them. It's a double problem. At the end of the day, focus on the existing business. You and I have to bear hug your brand loyalists. Peloton's a good business. Peloton has created a great community. I think what it is not is a growth company.
All right, let's leave it there. BMO Capital Markets, Simeon Siegel. Good to see you in person. Appreciate it.